There's a look at the U.S. futures as we got ready for a second conversation with David Rosenberg of Rosenberg Research. You can see there's strength in the tech stocks and the S&P 500. The Dow is down significantly by about 1.2%. We'll continue to watch those numbers for you. We're now 15 minutes away from the open of regular market trading on the final trading day of the week. David Rosenberg is back with us. He's founder and president of Rosenberg Research. What is your take on the U.S. economy right now and the effects that tariffs, Trump's own tariffs, will have on the U.S. economy?
Well, it's hard to know what tariffs are going to come in and what tariffs aren't going to come in. It's like I talked about Canada. We're in a complete bog of uncertainty. That bog of uncertainty alone, once again, it's the same in the U.S. The uncertainty is going to drag 1 to 2 percentage points off of baseline GDP growth, just that alone. So we don't know what trade policy is going to look like. And that's a problem in and of itself. There's like a change. If it's not by the hour, it's by the day. And that, again, is going to cause households and businesses to freeze up on their spending. On top of that, you saw the retail sales number yesterday. There's been so much front loading of production and consumer spending to get ahead of the tariffs. Is going to create this enormous vacuum on the economic data for the next several months. So the U.S. economy, look, the Atlanta Fed nowcast is negative 2.2 for the first quarter. We're going to get a couple of months. They're going to show a lot of pre-tariff buying. It's all artificial, and it's boring growth from the future. And I think the U.S. economy, it's not going to be as weak as Canada, but it's going to be weakening precipitously over the course of the next year. Until this trade situation is got some clarity. But I would not make that an assumption. I would make the assumption that the level of uncertainty is semi-permanent. Not permanent, because everything's executive order, okay? This is not legislation passed by Congress. However, these regulations are going to stay with us so long as Donald Trump is around. The chaotic environment is going to stick around for the next 3.5 years. We have to get used to that. Not permanent, semi-permanent. That alone is going to drive the U.S. economy into, if it's not a recession, the next level from a recession. So I think things there are going to weaken off precipitously, and we're seeing early signs of that already in the last few months.
We're in the early stages now of U.S. Corporate earnings season for the first quarter. One headline that's getting a fair bit of attention today is Alcoa, the big aluminum producer. It produces a lot of its aluminum in Quebec, and as it brings that aluminum from its own factories in Quebec into the United States to market, it says it incurred $20 million in duties since March the 12th, was when those steel and aluminum duties were put in place. It says in the second quarter the figure is likely to be $90 million. Do you expect that we'll hear more of this from corporate executives through the course of this earnings season, that they'll begin quantifying the hits to their businesses from tariffs and the costs that they will almost certainly have to pass on, at least in part, to their customers? As
best they can. And you've seen some executives, for example, we've got the bank earnings, some of them didn't even mention the word tariffs. So we're still in the bog of uncertainty where you can measure it accurately, like Alcoa. I think that you have to, in your due diligence and disclosure, have to announce what the impacts are. But you see, the elephant in the room is China, right? Like, we're talking about a $600 billion bilateral economic relationship between the U.S. and China that is going to collapse by at least 80%. And that's going to have all sorts of global ramifications. And Canada, being a small open economy, there's going to be, see, this is the one thing I'm talking about the Bank Canada, all these second round impacts globally are at least as powerful as the direct impacts of what the U.S. is going to do or not do. But I said before, the inflation is really a concern in the U.S. because the importer pays the duty and then has to decide how much will I pass on to the consumer. So you're talking about the U.S., it's not just Alcoa. These costs will get transmitted. Now, the Fed is concerned about whether this will be persistent. I don't think it will be persistent. I think what's going to happen is that it's going to hit a wall in the labor market, and the U.S. labor market is cooling off. And what that means is that real wages are going to contract. And then what's going to happen is that consumer spending, which is about 70% of U.S. GDP, well, that's going to contract as real work-based incomes go down. So that's what the overall effect is going to be. We're going to find out counterintuitively that inflation is going to be a lot lower coming out of this everywhere than it was going into it. But we're going to have a major price shock in the United States. The price shock's not in Canada. So long as we don't do the tit-for-tat tariffs, okay? The inflation shock's not in Canada, okay? The inflation shock is going to be in the United States, and it's going to be, I believe, that it will be, quotes, transitory, dare I use that word again. But this time around, the price shock, unlike 2021, 2022, the price shock is not coming into a labor market that's tightening. It's coming into a labor market that's loosening. So the big risk, and I would say the same thing to the Fed, because I think Powell yesterday was being overly hawkish. This inflation shock is going to hit the wall in the labor market. And the big risk is what it does to real incomes, real consumer spending, and then the negative feedback loop through to employment. And the next thing you know, and this is not in the market right now, the Fed will be scrambling to cut interest rates, okay? Just remember that was the script in 2019. And right now, this tariff war is on steroids compared to then. Back then, the Fed was threatening to hike rates. Do you know the Fed was threatening to hike rates in the first half of 2019? Next thing you know, second half of the year, they're cutting rates 3 times. And I think they'll be doing that even more this time around. And the beauty is that is not in the rates market right now, and that's why I like treasuries. That's why I like Canada's. I still like yield even at these low levels. Okay,
what do you think of stock markets? You think a recession is possible in both countries? That doesn't sound like a great setup for equities.
More than possible. That's the base case scenario for me. People will say, oh, there's the boy who cried wolf. To which I say, just remember, the wolf shows up at the end of the story. So I'm not saying I'm not outright negative on equities. It's not like I have 0% equities. I don't believe in 0. I don't believe in 100. But I believe in playing the probabilities. In the case of the stock market, let's say in Canada, for example, there are areas to invest in, okay? And I will go back. I talked about John Maynard Keynes. I'll go back to the theory of scarcity of value, as per David Ricardo. Scarcity value. What's scarce and what will continue to be scarce is yield as interest rates go down. That's what you want to own in the stock market. I'd say on both sides of the border, but primarily in Canada, where interest rates are still a lot lower than they are in the US. So you want to own yield in the stock market. Dividend yield, dividend growth in stable industries, and then the ones in the service sector that aren't going to get crushed by the tariff war with the United States. Well, that leaves you with some segments of the TSX that are attractive to me. What would they be? Utilities, okay, pipelines, selective REITs. I would even say the banks. And I'll tell you one area of the Canadian stock market, anything that touches travel and tourism, because Canadians are well ahead of their governments. There's actually right now a boycott, a travel boycott. Canadians are willingly saying, you know what? I'm going to go ski at Whistler instead of going to Vermont. You know, we're vacationing at home. The number of trips to the United States are plunging faster than the NASDAQ 100. And the Europeans are cutting back their travel too, and so are the Asians into the United States. Canada is going to be a more attractive destination. So anything that touches travel and tourism, we've written a report on that in Canada. That is actually, in this tumultuous environment, is going to be one of the silver linings in the cloud.
David Rosenberg, thank you for a couple of good conversations.
Thank you.
David.